Question 1. Types of term life insurance policies. Which of the following statements accurately describes a decreasing term life insurance policy? A. The death benefit remains constant throughout the term of the policy, providing a fixed amount to beneficiaries. B. The death benefit decreases over time, typically aligned with the insured's decreasing financial obligations, such as a mortgage. C. The premiums for this policy are typically lower than those of whole life policies, as it does not accumulate cash value. D. This policy can be converted to a whole life insurance policy at any time during the term without requiring evidence of insurability. Answer. B. Explanation. A decreasing term life insurance policy is designed to provide a death benefit that decreases over the term of the policy, usually in line with a declining financial obligation like a mortgage. This type of policy is beneficial for individuals who want to ensure that their beneficiaries are covered for specific debts that diminish over time. Option A is incorrect because it describes a level term policy which has a constant death benefit. Option C is accurate for both decreasing term and other term policies, but doesn't specifically define decreasing term. Option D is incorrect, as decreasing term policies typically do not include conversion options unless stated otherwise. Question 2. Underwriting process. An insurance agent is assessing a potential client's application for term life insurance. Which of the following factors would most likely lead to a higher premium being quoted for the client? A. The client is a non-smoker who exercises regularly and maintains a healthy weight. B. The client has a family history of cardiovascular disease but has no current health issues. C. The client has a full-time job as a corporate manager with minimal stress. D. The client is a young adult with no prior medical conditions and a stable income. Answer. B. Explanation. A family history of cardiovascular disease is a significant underwriting factor that can lead to higher premiums, even if the client is currently healthy. Insurance companies assess risk not only based on an individual's current health, but also their familial health history, as it may indicate a higher likelihood of future health issues. Option A represents a low-risk scenario that would likely lead to lower premiums. Option C describes a low-stress occupation that typically correlates with low risk. Option D also presents a low-risk profile, supporting a lower premium rate. Question 3. Scenario-based question. Mr. Smith, a 45-year-old small business owner, is considering purchasing a term life insurance policy to secure his family's financial future in the event of his untimely passing. He currently has a mortgage of $250,000 and plans to pay it off in the next 15 years. He also has 2 children in college and wishes to provide for their education. Which type of term life insurance would best suit Mr. Smith's needs? A. Level term life insurance for 20 years. B. Decreasing term life insurance for 15 years. C. Annual renewable term life insurance. D. Convertible term life insurance. Answer. B. Explanation. Decreasing term life insurance for 15 years would be the most suitable option for Mr. Smith, as it would align with his decreasing mortgage obligation over time. This policy structure allows for a death benefit that decreases as his debt diminishes, ensuring that his family is adequately covered for that specific liability. Option A, level term, would provide a constant death benefit which may exceed what is necessary as the mortgage decreases. Option C could lead to higher premiums over time and does not provide a guaranteed amount aligned with the mortgage. Option D offers flexibility but may not be necessary if Mr. Smith's primary concern is securing his mortgage and providing for his children's education. Question 4. Policy provisions and riders. Which of the following riders allows the insured to access a portion of the death benefit while still alive, typically in the event of a terminal illness diagnosis? A. Waiver of premium rider. B. Accidental death benefit rider. C. Accelerated death benefits rider. D. Children's rider. Answer. C. Explanation. The accelerated death benefits rider allows the policyholder to access part of the death benefit while still living if they are diagnosed with a terminal illness. This feature provides financial assistance for medical expenses or other needs before death. Option A refers to a rider that waives premium payments in the event the insured becomes disabled, which does not provide funds while living. Option B provides additional benefits in the case of death due to an accident but does not facilitate accessing the death benefit early. Option D is for adding coverage for the insured's children but is unrelated to accessing benefits early. Question 5. Premium calculation and payment methods. An insurance company evaluates a client's premium based on various factors. Which of the following factors would least likely affect the premium amount for a term life insurance policy? A. The client's smoking status. B. The client's occupation. C. The client's choice of payment frequency. D. The client's age at application. Answer: C. Explanation. While the payment frequency, monthly, annually, etc., may affect how premiums are billed, it typically does not influence the actual premium amount calculated based on risk factors. Factors such as the client's smoking status, A, occupation, B, and age at application, D, are critical in assessing risk and determining the premium. Smokers generally face higher premiums due to increased health risks, while older applicants typically have higher premiums due to the higher likelihood of mortality. Question 6. Regulatory framework in Kentucky. Under Kentucky law, which of the following is NOT? A requirement for life insurance agents seeking to obtain a license. A. Completion of a state-approved pre-licensing education program. B. Passage of a written examination. C. Submission of a background check for criminal history. D. Proof of being a Kentucky resident for at least 5 years. Answer: D. Explanation. While residency may be a requirement, it does not specifically state that an applicant must have been a resident for at least 5 years to obtain a life insurance license in Kentucky. Typically, the state requires completion of a pre-licensing education program, A, passing a written examination, B, and submitting to a background check for criminal history, C. Understanding the specific licensing laws helps ensure compliance and proper practice as an insurance agent. Question 7. Claims process. During the claims investigation process, the insurer discovers that the insured had misrepresented their medical history on the application. What is the insurer's most likely course of action? A. Deny the claim, citing the misrepresentation. B. Approve the claim but reduce the payout amount. C. Investigate further and request additional medical records. D. Automatically void the policy and refund premiums. Answer A. Explanation. If misrepresentation is discovered, the insurer is likely to deny the claim, especially if the misrepresented information is material to the risk being underwritten. Insurers rely on accurate information to determine insurability and risk levels, while option B could occur under certain circumstances if the misrepresentation was not fraudulent. Generally, any significant misrepresentation will lead to denial. Option C may be part of an investigation but would not typically result in an approval of the claim. Option D is incorrect because simply voiding the policy and refunding premiums is not standard practice. Claims can be denied based on misrepresentation. Question 8. Tax implications. Which of the following statements accurately reflects the tax treatment of life insurance premiums and death benefits in the context of Kentucky law? A. Life insurance premiums are tax deductible for individuals. B. Death benefits paid to beneficiaries are subject to income tax. C. The cash value accumulation in a permanent life insurance policy is tax deferred. D. Insurance payouts for terminal illness claims are fully taxable. Answer: C. Explanation. Under federal tax law, the cash value accumulation in a permanent life insurance policy is indeed tax deferred, meaning that policyholders do not pay taxes on the growth of the cash value until they withdraw it. Option A is incorrect as personal life insurance premiums are not tax deductible. Option B is also false. Death benefits are generally not subject to income tax for the beneficiaries. Option D is incorrect because payouts for terminal illness claims are usually not taxable as they are considered part of the death benefit. Question 9. Critical thinking and problem-solving skills. MS Johnson, a 30-year-old single mother, is reviewing her life insurance options. She wants a policy that would provide her with the flexibility to adjust her coverage as her financial situation changes in the future. Which type of policy would best meet her needs? A. Whole life insurance. B. Decreasing term insurance. C. Convertible term insurance. D. Annual renewable term insurance. Answer: C. Explanation. Convertible term insurance provides MS Johnson the option to convert her term policy to a permanent policy without needing to prove insurability, thus allowing for flexibility and adjusting her coverage as her financial situation changes. Option A. Whole life insurance typically involves higher premiums and less flexibility in adjusting coverage. Option B. Decreasing term does not provide the ability to increase coverage and would not suit her long-term needs. Option D, while renewable, does not offer the conversion feature to a permanent policy. Question 10. Market trends and consumer behavior. In recent years, which trend has significantly impacted consumer preferences in purchasing term life insurance policies? A. A decrease in the availability of online purchasing options. B. A growing preference for shorter-term policies over longer-term commitments. C. Increased awareness of the importance of life insurance leading to higher purchase rates. D. A shift away from the use of insurance agents in the buying process. Answer: C. Explanation. Increased awareness of the importance of life insurance has led to a higher number of individuals purchasing policies as consumers recognize the value of financial protection for their loved ones. While options B and D may occur, they are less pronounced trends in the broader market context. Option is incorrect, as the availability of online purchasing options has actually increased, making it easier for consumers to buy policies. Question 11. Types of term life insurance policies. Which of the following statements best describes the primary difference between a level term policy and a decreasing term policy? A. Level term policies have a fixed premium, while decreasing term policies have variable premiums. B. Level term policies provide a consistent death benefit, whereas decreasing term policies have a death benefit that decreases over time. C. Level term policies are renewable, while decreasing term policies are non-renewable. D. Level term policies can only be converted to whole life, while decreasing term policies can be converted to universal life. Answer: B. Explanation. A level term policy maintains a consistent death benefit throughout the term of the policy, while a decreasing term policy features a death benefit that diminishes over time, typically designed to cover debts that decrease, such as a mortgage. Option is incorrect because both policy types usually have fixed premiums. Option C is misleading as both types can have renewal features depending on the policy terms. Option D is inaccurate as both policy types can offer conversion options, though specifics depend on the policy. Question 12. Claims process. What is the primary reason an insurer might deny a claim during the claims investigation process? A. The policy was not renewed on time. B. The cause of death was not covered by the policy. C. The beneficiary did not file the claim within 30 days. D. The insured failed to pay premiums in the last 2 years. Answer: B. Explanation. The primary reason for denying a claim is if the cause of death falls under exclusions specified in the policy, such as death due to suicide within a specified time frame. Option O may lead to policy lapses, but is not a direct reason for denial if coverage is still valid. Option C is incorrect, as claim filing timelines can vary by state and a reasonable extension may apply. Option D would typically result in a denial if the premiums were not paid before death, but does not encompass the entire rationale behind claim denials. Question 13. Ethical and legal considerations. Which of the following best exemplifies an ethical violation in life insurance sales? A. Disclosing all policy details to the client before signing. B. Suggesting a policy based solely on the client's budget. C. Using misleading information to sell a policy to a client. D. Providing clients with multiple policy options to choose from. Answer: C. Explanation. Using misleading information constitutes an ethical violation as it compromises the integrity of the sale and undermines the client's ability to make informed decisions. Option A is standard practice and encouraged for transparency. Option B may not fully consider the client's needs beyond their budget, but it is not inherently unethical. Option D demonstrates good practice by offering clients various choices to meet their needs. Question 14. Regulatory framework in Kentucky. According to Kentucky insurance regulations, what is the minimum number of continuing education hours required for life insurance agents to maintain their license? A. 10 hours every 2 years. B. 20 hours every 2 years. C. 30 hours every 3 years. D. 40 hours every 2 years. Answer: B. Explanation. Kentucky law requires life insurance agents to complete a minimum of 20 hours of continuing education every 2 years to maintain their licenses. This regulation ensures agents remain informed about industry changes, legal requirements, and best practices. Options A, C, and D do not align with the state-specific continuing education requirements. Question 15. Calculating life insurance needs. Mr. Thompson is considering his life insurance needs. He has a current annual income of $80,000 and expects his children's college expenses to total $200,000. Additionally, he has a mortgage balance of $150,000 and final expenses estimated at $15,000. Using the needs analysis approach, what is the total coverage amount Mr. Thompson should consider? A. $335,000. B. $365,000. C. $410,000. D. $480,000. Answer: C. Explanation. To determine the total coverage needed, Mr. Thompson should consider income replacement, typically 510 times his annual income, assuming 5 times 5x 80 this equals 400,000, children's college expenses, $200,000, mortgage balance, $150,000, final expenses, $15,000. Calculating this, total coverage equals income replacement plus college expenses plus mortgage plus final expenses. Total coverage equals 400,000 plus 200,000 plus 150,000 plus 15. This is equals 765,000. However, if only considering immediate needs without income replacement, 200,000 plus 150,000 plus 15, this is an equal 365,000. Thus, the correct answer based on immediate needs is B if we consider only existing liabilities and expenses. Question 16. Underwriting process. During the underwriting process, which factor is least likely to impact the risk classification of an applicant? A. Family medical history. B. Current health status. C. Occupational hazards. D. Recent travel to a foreign country. Answer: D. Explanation. While recent travel may be considered, it is typically not as significant as family medical history. A. Current health status. B. And occupational hazards. C. Family medical history can indicate genetic risks. Current health reflects present risk. And occupational hazards provide insight into lifestyle-related risks. The underwriting process focuses primarily on these more critical risk factors when determining premiums and insurability. Question 17. Types of term life insurance policies. Which of the following scenarios illustrates the best use of a convertible term life insurance policy? A. A young couple wants life insurance with low premiums but plans to purchase a permanent policy in the future. B. An older individual requires immediate coverage but cannot afford permanent premiums. C. A small business owner needs coverage for key employees and wants the option to convert later. D. A retiree looking to maximize their investment in life insurance without needing coverage. Answer A. Explanation. A convertible term policy is ideally suited for individuals who want the affordability of term insurance but anticipate transitioning to a permanent policy later, such as a young couple. Option B may indicate a need for immediate coverage but does not highlight the conversion aspect. Option C could also apply, but the scenario does not focus on personal needs or future plans as much as Option A. Option D is irrelevant, as retirees typically do not seek new life insurance policies. Question 18. Tax implications. Which of the following statements regarding the tax treatment of life insurance premiums and benefits is correct under federal law? A. Premiums paid on term life insurance are tax deductible for individuals. B. Beneficiaries are taxed on the full amount of the death benefit received. C. The cash value growth in a permanent life insurance policy is tax deferred. D. Accidental death benefits are always taxable to the beneficiary. Answer: C. Explanation. The cash value growth in a permanent life insurance policy is tax deferred, meaning the policyholder does not pay taxes on the growth until funds are withdrawn. Option A is incorrect, as individual premiums for personal life insurance are not tax deductible. Option B is false because beneficiaries typically do not pay income tax on death benefits received. Option D is misleading. Accidental death benefits usually are not taxable either. Question 19. Ethical and legal considerations. A life insurance agent recommends a policy with a higher premium than what the client initially expressed interest in. This recommendation is based on the agent's assessment of the client's needs. Which ethical principle is primarily being upheld? A. Transparency. B. Best interest of the client. C. Fairness. D. Integrity. Answer: B. Explanation. Recommending a higher premium policy based on the agent's assessment of the client's needs demonstrates the principle of acting in the best interest of the client. The agent aims to ensure that the client receives adequate coverage for their specific situation, while transparency A and integrity D are also essential. The focus on the client's best interest is the key ethical consideration here. Fairness C relates to equitable treatment but does not capture the essence of this recommendation. Question 20. Claims process. When a beneficiary files a claim for death benefits, what is the primary document required to initiate the claims process? A. The insurance agent's report. B. A copy of the death certificate. C. The policyholder's medical history. D. The beneficiary's identification. Answer: B. Explanation. A death certificate is the primary document required to initiate the claims process, as it serves as legal proof of the insured's death. While option A may be useful, it is not mandatory to start the claim. Option C is not typically required for claims processing unless specific health-related inquiries arise. Option D, while necessary for identity verification, does not replace the need for a death certificate to substantiate the claim. Question 21. Conversion options. Under what condition is a term life insurance policy typically convertible to a permanent policy? A. Only within the first year of the term. B. At any time during the term period. C. Upon the insured's request and payment of the difference in premium. D. Only if the insured's health has not changed. Answer: B. Explanation. Most term life insurance policies allow conversion to a permanent policy at any time during the term period, regardless of changes in health. This feature provides flexibility for the policyholder to transition to a permanent solution as their needs evolve. Option A is incorrect because most policies do not limit conversion to just the first year. Option C misrepresents the process. While additional premiums may be required, conversion does not depend solely on the insured's request. Option D is misleading as conversion is typically allowed regardless of health changes. Question 22. Insurable interest. What is the concept of insurable interest in life insurance? A. The policyholder must be related to the insured. B. The policyholder must have a legitimate interest in the life of the insured. C. The insured must have a financial obligation to the policyholder. D. Insurable interest is only required at the time of claim. Answer: B. Explanation. Insurable interest refers to the requirement that the policyholder must have a legitimate interest in the continued life of the insured, meaning they would suffer financial loss if the insured were to pass away. Option A is incorrect as it is not limited to familial relationships. Option C, while partially correct, is too restrictive since financial obligations are not the only form of insurable interest. Option D is false because insurable interest must exist at the time of application, not just at the claim stage. Question 23. Riders in life insurance. Which of the following riders would provide additional coverage for a critical illness under a term life insurance policy? A. Waiver of premium rider. B. Accidental death benefit rider. C. Accelerated death benefit rider. D. Term conversion rider. Answer: C. Explanation. The accelerated death benefit rider allows the policyholder to access a portion of the death benefit if diagnosed with a qualifying critical illness, providing financial support during treatment. Option A is a benefit that waives premiums if the insured becomes disabled. Option B provides additional coverage if death results from an accident, while Option D allows conversion to a permanent policy but does not relate to critical illnesses. Question 24. Policy lapsing. What typically occurs when a term life insurance policy lapses due to non-payment of premiums? A. The policy remains in effect for an additional grace period. B. The insured is automatically covered under a different plan. C. The policyholder can reinstate the policy with a penalty. D. The policyholder loses all rights to the death benefit permanently. Answer A. Explanation. Most term life insurance policies include a grace period after the premium due date during which the policy remains in effect, allowing for payment without losing coverage. Option B is incorrect as there is no automatic transition to another plan. Option C may allow reinstatement but often involves proof of insurability and back premium payments, not simply a penalty. Option D is misleading, and while the death benefit is not payable if the policy lapses, the policyholder does not lose all rights indefinitely since reinstatement options often exist. Question 25. Underwriting classifications. Which underwriting classification typically denotes a higher risk and results in higher premiums? A. Preferred. B. Standard. C. Substandard. D. Preferred best. Answer C. Explanation. The substandard classification indicates a higher risk of mortality and is associated with higher premiums due to health issues or risky lifestyles. Preferred classifications A and preferred best D indicate lower risk and thus lower premiums, while standard B typically denotes average risk. Question 26. Policy exclusions. Which of the following is a common exclusion found in most term life insurance policies? A. Death resulting from natural causes. B. Suicide within the first 2 years. C. Death from an accident while driving. D. Death due to illness after the policy has been in force for 2 years. Answer: B. Explanation. Many term life insurance policies include a suicide exclusion during the first 2 years where benefits are not paid if the insured dies by suicide. Option A is incorrect as natural causes are typically covered. Option C is generally covered unless other exclusions apply. Option D also does not apply because illness is usually covered if the policy has been in force long enough. Question 27. Policy dividends. How are dividends treated in a participating term life insurance policy? A. They reduce the death benefit. B. They are used to pay premiums automatically. C. They are taxable income to the policyholder. D. They can be taken as cash, used for premiums, or left to accumulate interest. Answer: D. Explanation. In participating policies, dividends can be taken as cash, used to pay premiums, or left to accumulate interest. They do not reduce the death benefit and are generally not taxable as income. C. Unless exceeding premiums paid. Option B is correct but does not encompass all options available for handling dividends. Question 28. The need for life insurance. What is a primary reason for individuals to purchase term life insurance? A. To build cash value for retirement. B. To provide financial protection for dependents in the event of death. C. To ensure coverage for their entire lifetime without health concerns. D. To benefit from investment opportunities. Answer: B. Explanation. The primary purpose of term life insurance is to provide financial protection for dependents in the event of the insured's death. Option A relates to permanent insurance that builds cash value, while option C inaccurately represents term insurance, which provides coverage for a limited time. Option D is misleading since term insurance does not offer investment opportunities. Question 29. Replacement of insurance policies. Which of the following best describes the importance of the replacement rule in life insurance? A. To prevent agents from earning commissions. B. To ensure clients are informed about the risks of switching policies. C. To encourage the purchase of multiple policies. D. To allow for more affordable premiums. Answer: B. Explanation. The replacement rule is designed to ensure that clients are informed about the potential risks and implications of replacing one policy with another, including any loss of benefits or increased costs. Option A is incorrect as the rule is not aimed at commission issues. Option C does not reflect the intent of the rule, and option D is misleading while replacing may sometimes lead to lower premiums. That is not its primary purpose. Question 30. Regulatory compliance. Which of the following is a requirement for life insurance agents in Kentucky to maintain their licenses? A. Must pass an annual examination. B. Must complete a specific number of continuing education hours every 2 years. C. Must maintain a minimum sales quota. D. Must receive training from multiple insurance companies. Answer: B. Explanation. In Kentucky, life insurance agents are required to complete a specific number of continuing education hours every 2 years to maintain their licenses. This ensures agents stay updated with industry changes and regulations. Option A is incorrect because annual examinations are not standard and they typically occur at the time of initial licensing. Option C is not universally required, and option D is misleading as training is not mandated from multiple companies.